All right, good evening, good evening. Welcome, welcome. It's good to see everybody. You should be seeing my screen. I have my chat box open. I'm letting people get in, let their audio turn on. We'll give it just about a minute. Hope everyone's feeling all right. Ooh, what a day today. Um, There was not a lot of time, but some time to get some trades on. Hopefully, you have some bullish trades on. Whether you found some bounces, some continuation trades, very strong today. Our posture had its second straight increase. We said we're now definitely looking for bullish opportunities. No hedges in sight. Looking to clean up any remaining bearish. So hopefully all of that was enacted. And if it was, you should be in a pretty good place. Anytime you have a big day like this, you're going to be like, man, I wish I had more. Of course you are, right? Of course you are. Remember, it's really, we're coming out of a pretty shaky market that deviated from a cyclical norm. So there was some concern. So if you have a little less on than you would like, at least you have something on. And as long as things continue strong, we'll continue to build into the momentum. All right, everyone's in. That's going to be here for the beginning. So welcome out everyone to the Market Watch Group Trading Foundations course. So if you're listening to the recording, excuse me. If you're listening to the recording, the little intro conversation may or may not make sense depending on how long you wait to hear it. For those of you who are live, you know what I'm talking about with today's market. Today we are talking about intro to options. So this will be interesting because we are near the tail end of the Trading Foundations course. So if you go into the content library, the entire thing for the most part is in there. We're wrapping up. We're now doing intro to options. We're going to do a post-trade assessment course or session. Right, we're gonna do just an open Q&A session, just a couple of things to wrap it up, cross the T's, dot the I's. But in December, we are now going to do a options foundations course. So what we're going to do today and on Thursday, part 1 and part 2, this intro, we're going to scratch the surface. So in December, there'll be a little bit of a repeat just to kind of remember it's a foundation. So we're going to just really make sure you're comfortable with the concept of options, what they are, how they work, reading an option chain, setting up trades, managing trades, starting to think about spreads. Lot of good stuff in options. You'll see when we talk about some of the advantages and some of the characteristics of options, they really make sense for what we do. When we are a 0, a 1, a 2, do I have an inability to trade? When you trade options, this is not something that in this course I'm going to do much of, because it would just, anyone who was new would find themselves lost, and that's not the intent of what we're doing here. But the concept of spreads, butterfly spreads, condors, spreads that put time on your side, that when the market's just kind of meandering around and nothing's really moving very well, great, make money from time decay, right? There's actually several different ways to put that as an advantage when it comes to options trading. So if you have a very specific market analysis like we do, where we assess the VIX and volatility as an overarching characteristic of the market, we know if volatility is expanding or if it's declining, right? Escalating or de-escalating. We know if it's high or low. And based on that, we can actually use that very specifically to pick and manage our options trading. So just as we get into options, As we get into the concept of options and understanding options, just think about that. Our trading should be reflective of our market posture, and options give us an ability to really fine tune that concept. So, closed out 4 winners today. Love it, Bob. Thank you for sharing, Michael. Best of luck. Okay. Okay, fair enough. Yeah, so Bob said, surprise, the market isn't more worried about a shutdown Friday. VIX barely moved. And that's exactly right. It's not. We'll talk about that tomorrow morning. But that's the right observation. Not that, we're sometimes we get caught up like, well, that doesn't make sense. Sure it does. It makes perfect sense. So, all right, let's do it. My name is Scott. I know we have a few new faces in here, relatively new, so welcome out. This might be your first time in one of these foundations classes. Here, the market's closed. What are we doing here? We're making sure that every aspect of what you need for your trading plan, all the little things that all of a sudden you realize, you know what, I do need to understand this a little. I do need to understand order types a little better, or the charts a little better. I need to have whatever it might be. This is going to just help really have a firm foundation, hence the name, to build your trading on. Let's dive in. Normal disclaimers, as always, those are in your email. Here's what we're doing today. Why options? I don't believe that it's like, hey, options are pretty good. I think it's a necessity. That's my opinion. We need the leverage. We need the flexibility that options give us, the ability to adapt to price, time, and volatility conditions, and get those elements working in our favor. If we can do that, they're hugely advantageous to us. So that I think that they're a necessity for a trader who goes through what we do in understanding market conditions. We're going to define them and talk about the concept of, okay, well, what are we doing? I'm working off of the assumption that some of you are like, I have no idea what an option is, Scott. Great. We're going to talk about that. Some of you might be like, I know exactly what an option is, and maybe we'll challenge some notions you have. There's a lot of bad information out there about options and options trading, just like anything, right? In gimmicky sayings about options that, we're going to challenge some of those assumptions. I would expect. There are 2 basic types of options: calls and puts. Those calls and puts are the building blocks for many, many different things, because we can buy them or we can sell them, which means we can be long or short. You can see that's something we're going to talk about here today. And then we can start to do combinations of them. And that's something we're going to talk a little bit today, that they become building blocks. Calls and puts become building blocks for more sophisticated strategies that really allow us, like I said, to fine-tune strategy according to market condition. We're starting with the building blocks. That's what we're doing here today, right? So if you're thinking, oh, great, you're going to talk about spreads? No, I'm not. I'm going to talk about the building blocks. What's a call? What's a put? What does it give me the right to do? We're going to talk about the basic components to make sure that you are moving forward into this world where we speak a different language. We'll probably touch on the Greeks next week, option Greeks, but it's important that you move into this realm confidently. I'm going to highly suggest paper trading. There's a paper trading session in Trading Foundations course, but I'm going to highly suggest you utilize that resource to really practice a few things with options, get some free experience before you move forward. We'll talk about the key terms in options. What are the definitions that we need to understand? And again, we're not going to hit them all. We're going to just get the basics in place. Next week, next session, we'll get a few more. The standard characteristics of options. How do they behave? What do we need to know about them in order to trade them? We're going to talk about some values, intrinsic value versus extrinsic value, and Why are they important to us as traders? A little bit in the building block fashion about long versus short. Which side am I on? And lastly, we're going to just do a quick overview of buying options. These things are going to get covered in more detail in the Options Foundations course. We're going to do more hands-on in a trading model. I'm going to be using Thinkorswim, which is my platform. It's now Thinkorswim by Charles Schwab. If you don't have it, I believe you can now open a Schwab account. I don't think you need to fund it. I believe, will give you, it's brand new. They just barely took over as for, at least for me. But and you can do some paper trading and learn the platform, practice some options, get your feet wet, get comfortable. So there you go. Let's dive in. Send questions as they come. There will be some time at the end, but definitely let me know if you have questions along the way. Why are options so important? Number one, they make us better at risk management. They enable us more tools to mitigate risk, right? We can control risk. With a lot of people think, oh, options are so risky. They're as risky as we let them be. They're as risky as we build them to be, based on the way we construct a trade and the number of contracts. It's not like, oh, you just are, at the whim of the options puppet masters, right? No, we get to decide. So like I said, there's a lot of misconceptions about options, but they're actually quite effective tools to help us better manage risk according to market condition. They give us the ability to enhance returns, hedging right off the bat every year. And I tell people this, if you do hedge, and if you're in this group, you're going to, it's in our trading plan. Well, one of the things we're going to do is we're going to, in your trading log, it says to log what system. That system is a hedge. So when you do a hedge trade, you put hedge. And at the end of the year, you go and you isolate all of your hedge trades. And then you look and you say, did my hedges have a positive expectancy, right? Did I make money on my hedging? Now, if you lost a little bit, and I know this isn't options, but this is just a quick deviation. It is important. If you lost a little bit, but you had a great positive return, that might mean that there was some choppiness in the market and you protected yourself. Okay, still positive, overall great. But for the most part, I expect my hedge activities to be positive, period. Right? I should be making money when I hedge. So they give us the ability to enhance returns. They give us the ability to make money in a sideways market. You could maybe try to buy at the low, sell at the high. Everyone's like, oh yeah, but nobody likes trading a sideways market. But I can put on trades that just kind of sit there and make money from time decay. Butterflies, condors, diagonal spreads, calendar spreads. There's a number of different things I can do to enhance my ability to profit in given market conditions. Portfolio diversification, we can spread exposure across different assets and strategies. In fact, if you're a swing trader and you get a signal on a stock and you're thinking, oh, it's a $50 stock, I'm going to put my stop loss at 47. That's $3, right? $3. So if I have a $20,000 account and I take 2% risk, that's $400 of risk. I'm going to buy 125 shares approximately. That's like $6,000. If it's a $20,000 account, $6,000 in one trade is 30%, right there. A lot of people are like, oh, I thought I'm never supposed to have more than 10% in one trade. Well, if you're a swing trader and you buy stock, unless you buy on margin, you have to figure that out. Or if you just decide, well, I'm going to trade less, well, then you're not going to make as much money as you would have. Options, on the other hand, now, if you did that also thinking this, you're only going to have the ability to put 3 trades on. After 3 trades, you're 90% invested and you get a 4th trade, you can't trade anymore. We need the leverage in order to get our money. I want to be able to put myself in that situation. 3 trades, you're 6% at risk, 6%. In our risk management, in our record keeping, one of the things we learn about is Kelly criterion, which is risk optimization. There's a good chance you're going to want your account 15% at risk in good markets. You can't only have 6% of your account at risk in a good market. You've got to get it out there. You've got to get your chips on the table. So we need options in order to give us leverage, to give us the ability to manage risk on a trade by trade basis, but still open it up a little bit more and actually make some money in our trading. Okay. Like I said, they can be used in various market conditions. They give us leverage. And the last thing is this: we get to design the reward to risk profiles. We get to decide how much risk there is. We get to say, you know what? I'm wrong if it drops down to here. I can say if it goes down a little, I'm okay. If it goes sideways, I'm okay. If it goes up a little, I'm okay. If it goes up a lot, I'm okay. I can build a trade that in that scenario, as long as it doesn't go down a lot, everything else makes me money. Sideways makes me money. Up makes me money. I get to dictate that. That's why it's worth learning. If you've thought, I wonder if I need them, the answer is yes, you do. You want to learn how to trade options. We're going to give you the great starting point. I'm going to give you some resources that will allow you to build on that. Yes, absolutely. Definition and concepts of options. Options defined. What are we doing with them? They're financial instruments. They're actually technically contracts, right? It's a contract with a buyer and a seller that grant the holder, the buyer, the right. It's rights and obligations. That's what I want you to think about in options. Rights and obligations. As a buyer, we have rights. We have the right, but not the obligation to buy, if it's a call, or sell, if it's a put, an underlying stock, in this case, asset, but in this case, stock within at a predetermined price within a specific period of time. What are we doing? We're locking in a price. We think it's going up, so we lock in a buy price. That's a call. We think it's going down, so we lock in a sell price. That's a put. That's the basic premise of our building blocks. When we learn options as building blocks, we learn them from the perspective of a buyer. Eventually, do we want to think about them from the other side? Like, oh, well, if these are my characteristics as a buyer, what happens if I'm a seller? Well, flip them upside down. If time is working against you as a buyer, it's working for you as a seller. Right? If you want it to go up as a buyer, you don't want it to go up as a seller. You don't need it to go down, actually. You just don't want it to go up. Those are the things that we'll be thinking about. So let's specifically go into a brief definition, and then we're going to hit each one a little bit more detail. Call options. What does it give you the right to do? It gives you the right to call somebody out. I want your stock. Literally, that's what it is. You're calling them out. You don't know who it is, by the way, right? Typically, when you buy an option, there may not be like an established inventory. What does that mean? It means that a market maker is essentially creating that option. He's the seller, right? He's the seller. And eventually, he wants to find somebody else to take his place as the seller. So the market maker is just a bookie, right? So if everybody is buying options, what are they doing? They're raising the price of options in order to attract sellers. They're going to keep raising the price until eventually the people stop buying them and they start selling them, and they start to attract sellers. That's the concept of implied volatility. The more we think something is going to happen, the more we're willing to pay, right, to speculate on it. So if you're like, oh, this stock's going to make a huge move, well, then those options are clearly going to be more expensive. The more people think it's going to move big, the more they're willing to pay for it. So if everybody's buying them and you're a market maker, of course, the option price goes up. Okay, so the put option is the opposite side. What does it give you? Remember, the perspective is from a buyer. I am a buyer of a put. I have the right to take a stock and give it to you. I put it to you. Call option, I call it from you. Put option, I put it to you. I have the right to force you to buy it. Why would I do that? Right? Well, because if a stock was $100 and I'm like, this stock is dropping to 75 and I buy a put at $100, I have the right to sell it to somebody who doesn't matter. Right now, it's the market maker. Eventually, the market maker is going to have a seller on that. When there's a seller, when there's options, they take all the buyers and they put them in a pool. And they take all the sellers and they put them in a pool. And if a buyer says, I want to exercise, it's not in our definitions today, but I'm going to hit it anyways. We'll talk about it more next week. Exercise, that means you decided you want to actually enact the contract. You want to force somebody. Here's what I'm going to tell you. That's not what I'm interested. I don't buy options to actually enact the stock. If you buy an option, if you buy a call and then buy a stock, you paid more for the stock than if you would have just bought the stock in the first place. That's not an advantage, right? That's not an advantage. We use options to control the stock so that I can control 300 shares of stock for a fraction of what it would cost me to buy 300 shares of stock. That's the intention that we're working with here. So I have the right now. If a stock is 100 and it drops to 75, I have the right to force somebody, theoretically, to buy it for 100. So what could I do? I could go out on the market, buy that stock for $75, then exercise my put, and then force them to buy my shares. And now I made $25 a share. But guess what? That $25 is built into my contract. So I can just sell the contract. I don't need to go through the extra hassle and commission and time of exercising and selling and waiting for T+3 settlement on a stock. I just do the contract itself. That's what's great, right? These price fluctuations as the stock moves are getting built into the price of the contract. So that's what I'm trading, is the contract. Now, remember this, at or before expiration. That's important. We're going to go into that in more detail. Let me know if any of this doesn't make sense yet. Give me a still here, Scott. Let me know that you're with me. I know it's a lot. That's why we record it. Let's get into the specifics of each type of contract. These are the building blocks. It's a hard thing, right? Because you need to have a sense of the overarching, like the 30,000 foot view, but it doesn't make sense when you don't understand them. But you can't really understand them without. So it's like, which do we? We're trying to do the chicken and the egg at the same time here to some extent. So here's what we're talking about with calls. And again, our explanation is coming from the perspective of a buyer. That's our building block. A call gives us the right to buy. Options give the holder, the buyer, the right, but not the obligation, to buy the underlying asset at a predetermined price. That's the strike. What are we doing with this? This is a bullish position. If you think the stock is going up, the market is going up. If you think gold, oil is going up, if you think whatever you think is going up, a call will help you capitalize. Now, it's not that simple, right? We can't just buy any call. We need to also understand, well, up over what period of time? Because time is a very important consideration when it comes to options, because we have a finite amount of time for the move to happen. Because time is, as a buyer, this is our perspective, is working against you. The second you buy an option, it's like you took an ice cube out of the freezer. Starts melting. And then you start walking towards expiration. It's a fire. Well, the closer you get, the faster it melts, right? So time doesn't typically expire at a linear fashion. It's an exponential curve. So it's slow, 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 and then it starts to fall off the cliff. So if we can trade in that first period where it's slow, 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 and then get out, we don't have to be in the trade when it goes through that fall off a cliff. That's the point, right? That's what the understanding we're trying to gain here is going to help you do. Ideally, if I do my job right, that's what it's going to help you do. So make sure you ask me questions and hold me to it. Thank you, Bob. I appreciate that. Okay, so we're bullish. We're looking to profit from the upward movement. Strike price. That's the right. So if I say I have a $50 call, $70 call, $100 call, when you hear people put the number with the call or the put, they're saying the strike price. That's the agreed upon price. Typically, that's going to be somewhere near the current price. We're going to talk about, like, in fact, I'm realizing I don't have it in this. We're going to kick this to next presentation as well. In, at, out of the money. We'll probably touch it here, but we'll get it into more detail in the next session. But we're close, right? You're not going to see a $100 call on a $500 stock. That's just, I mean, they probably exist, but not for us. The strike price is that's what we're actually trading. That's what designates that specific contract. The expiration date, also part of that. So I say, oh, I have a December 75 call. That's the expiration and the strike price. So I know what I have there. Now, that means I technically have until, in that case, the third Friday of December. But do I really? Well, no, not if I want to avoid that cliff, right? So that's where we're going to get into the subtleties. And in the options foundation class, I will teach you how to use an options pricing model that allows you to actually, forecast your potential trades so that you can see what would happen to the option a day from now, 3 days from now, 5 days from now. What would happen if the stock goes up $1, $2, $5? What would happen, right? So as the variables change, it'll be really, really fascinating stuff if you have intention of trading options. And like I said, you absolutely should. And profit potential. What is the profit potential? This is why people love call options, because theoretically, your profit potential is unlimited. A stock could go up forever. It never does, but it could, right? But it could. So that's what we're looking for here. Realistically, what am I looking for? I'm looking to get 3 to 1. When I say underlying asset, is that the stocks? It's the stocks. It could also be like an index. So for example, you can trade options on the SPX. You can trade options on the VIX. You can trade options on indices. You could trade options on futures. They typically, people love derivatives. That's what we're talking about here. But yes, in our case, we're basically saying, when you think about our watch list that we have, that we maintain, every single one of those are going to be highly liquid options, meaning multiple market makers, competitive market, tight bid-ask spreads. That's the kind of, I don't want to trade illiquid options. I've done it before. It's the most frustrating thing. You just can't, you don't get what you're expecting because you're fighting upstream. One of my screening criteria, most definitely, Bob, right? I'm expecting 2 million shares. And even then, I'm going to look at some of those options and be like, you know what? They're not good enough. I think the number right now is like 3,500 stocks technically have options. 90% of them are literally trash. Like I could list 300 to 400 companies where I would be willing to actually trade options right now. The rest of them, you're dealing with you're dealing with illiquid markets. You're dealing with market makers who don't want to compete. Right? I want the competitive markets that are efficient. Okay, so that's calls. Puts. Flip it. What do I have? I have the right to sell. Put options provide the holder, the buyer, with the right, but not the obligation. So who has the obligation? You might ask. Well, whoever's on the other side, the seller, they're obligated. So if I'm a buyer, I could say, hey, you know what? I want to exercise this. My broker's gonna tell the OCC, the Options Clearing Corp. The Options Clearing Corp are the ones who maintain the pools, right? Everybody's in a pool. And so they say, oh, John Doe has 10 contracts and he's decided he wants to exercise them. So what are they going to do? They're going to do a random assignment. Exercise is what buyers do. That is our right to exercise. Assignment is the consequence. A seller in that random pool is going to be picked. And if you get the short straw, it happens. It's not like, hey, are you good if we do this? It's like, bam, it's gone. Whatever you had put up is gone. So whether you have a missing stock or a balance that needs to be satisfied, you are obligated. The obligation was called or it was put to you, and it must be fulfilled. You are obligated as a seller. Bob said, I've gotten the short straw 3 times. Not fun. Yeah, it can bust a trade. Now, real quickly, this is into my slides. This is just a little fact, a little trivia fact about options. Stock options, which is what we're going to deal with. We deal with stocks and ETFs, are American style options. American, I don't know, think freedom, but you have the ability to exercise at any time. Versus what? Versus European style options. European style options are index options. Now, why are index options not American? Because if it's an index option, you're trading a number, right? I can't be like, I'm going to force you to sell me the SPX index. They're like, oh, the number? Because there's no shares there. The SPY ETF is shares, and you can force the delivery of shares. But an index is cash settlement, which means that they cannot be exercised except on expiration day. So up until then, you can buy the contract and sell the contract. But European style options, which are index. So if you ever buy SPX, VIX, anything with an X, which is an index, those are going to be treated just a little bit different. They're taxed a little differently too. So if you start making some big money, you would want to look into them because they do have some tax advantages to them. But that's not where we are today. We're back to the building blocks. So okay. Did I advance? I did. Same, again, to the opposite, bearish trades. When you think it's going to go down, you're going to buy a put. That's the basic premise behind buying a put. We have a agreed upon price at which I can sell the asset. That's the strike price. I have a specific amount of time as dictated by the expiration date. The standard expiration date is the 3rd Friday of the month. 15 years ago, 20 years ago, when I first was on the market myself, there was only like 4 or 6 options. There'd be a couple of short, couple longer, and maybe leaps. There was no weeklies. Now you have weeklies. You have 3 times a week with SPY. You have quarterlies. You have all kinds. Tons and tons and tons. The more that trades, the more they offer more contracts. So there's a lot of different expiration dates available to us. Profit potential from a put is significant, but it's the same as always. What am I trying to do? I'm looking for a swing. I'm trying to get 3-to-1 on my money. And I'm hoping to, have the leverage to not have to tie up a bunch of the assets. That's the core objective. So let's just circle back and confirm a couple of key terms. Strike price. I've said it multiple times now. That should be much more comfortable for you. That's the predetermined price. That is the determinant of the contract. So when I describe an option, if someone said, oh, I have an option on this, Well, clearly I would want to know, A, what type? Is it a call or a put? B, what strike price? C, what expiration? And realistically, I would actually want to know, is it long or short, right? Are you a buyer or a seller? But for now, we're only moving with the perspective as buyers. So those are the three variables, right? So strike price, expiration date. Remember that right now, I would actually expect the vast majority, if you're using our watch lists and or stocks along those lines, I would expect pretty much 90 to 95%, if not all, to have weekly options. There may be a few, but most of what we have, you're going to have 6 to 8 weeks worth of options. You're going to have 2 or 3 months that are close by. The 3 months out wide open. Typically, I don't need more than that. If you start doing longer term strategies, they're available. There's plenty there as you get further out in time as well. And premium. Oh, sorry, expiration date. Remember this. An option must be exercised or sold, or else one of two things will happen. If it has intrinsic value of any kind, a penny, what does that look like? If I have a $50 call option and the stock is at $50.01 at expiration, the broker's going to exercise that and buy the stock and make sure I keep that penny. Right? So it used to be 25 cents. Now most brokers, and you can check the verbiage, I might be wrong, they maybe have shifted. When I worked on a trading desk, it was 25 cents or more. Now it's just, if it's in the money at all, they're just gonna exercise it. A penny? Yes. A penny. There you go. Bob said a penny is right. So a penny, yeah, they're gonna automatically buy that sucker for you. So, don't just sit on the option. You shouldn't really be there anyway, to be fair. My question would be, hey, why are you still in that option on expiration day? Because it seems like you should have been starting that trade 4 or 5 weeks in front of expiration, expecting to be in the trade for maybe 7 to 10 days. Maybe. No way you're going to stay in for 30 days, right? Like, what does that mean happen? It means you just sort of sat on it and watched it. Now you're like, well, now what should I do? So I don't know. I mean, that's a tough situation. You shouldn't be there as far as what we concern. But it's either going to auto expiration. I meant auto exercise. I typed that wrong. My fault. Auto exercise. Or if it's out of the money, it'll expire worthless. Nothing happens. That's it. You've lost everything there. The premium is the cost you paid for the option representing its market value. Remember this. Options are quoted per share. So if it says $3, that means it's $3 per share, and a contract controls 100 shares. So that would be $300 per contract. Bob, don't say that. Standard characteristics of options. You control 100 shares. They expire at midnight on Saturday. Why is that important? You can't trade them after Friday. Well, guess what you can still do on Saturday? If news, let's say like, the Jerusalem news, there were people who got exercised and they thought, oh, I'm in the clear. And then all of a sudden on Saturday, people start calling in and exercising options that weren't in the money, but they figured would be come Monday when the markets dropped. So don't just think that Friday comes and it's gone. Those things are alive until midnight on Saturday. And typically they expire third Friday. It's your standard. That's where you're going to find the most amount of volume. But they have weeklies as well. And if they have weeklies, they're going to be every 6 weeks. What else is standard? They give you more flexibility. You can start building combinations and spreads. Expiration dates, like I said, you're going to have 8 weeks in a row. You can find what you need, especially when you have liquidity as a primary factor. Strike prices. So strike prices are pretty standard. If you have our list, you're usually going to find dollar increments. Every dollar is a strike price around the money. So it's very easy to find the strike you want and to build the trade that you want. And remember that we have rights, not obligations. Real quickly, intrinsic value versus extrinsic value. Intrinsic value is in the money. So it's the inherent value of an option. A call option is positive when the market price is higher than the strike. A put option is the opposite of that. Extrinsic value is time value. So if you're buying an out of the money option, you're buying all extrinsic value. And I'm okay with that. Just keep that in mind. Remember that the decay factor, extrinsic value diminishes as the option approaches its expiration date. These are all things we're going to get into. And I know it's hard to pick in even 1 and 2 days what I want to cover. I'm glad to know I have 8 days to cover this in more detail where we can build the trades and really get you comfortable with these. Long versus short, you're a buyer or you're a seller. If you're a buyer, you hold a position, you have rights. If you're a seller, you have obligations, right? Now, if you buy options, you have unlimited profit to the upside, and you have a fairly close to unlimited profit to the downside for puts. The loss is limited to the premium you paid. Short options can be a lot worse, right? That's when you're naked options. So if you've ever heard of naked puts, naked calls, those are short options. They can be substantial. So you have to be careful. However, you don't have to be scared. Real quickly, did you miss the email with the link to the library? Every email that I send has the link to the library, Fred. So any email that you've gotten, if you just scroll down it, you'll see there's 3 core links in every email. The first email is for the welcome doc. That's where you can download things like the trading plan and the logs. The second one is the content library. That's where you can access all of the recordings that we have in the past. The third one is the schedule and links. That's the source of truth to make sure you can always get into the meetings. So yes, that should, in fact, I'll send a recording of tonight and that will have it in there as well. Okay, buying options. That's what we're going to get into. I'm going to kind of punt on this one. This is going to start next week. We're going to start next week with an overview of buying options. It's going to lead us in. So we're going to talk about what our objective as buyers are, sellers, or for calls, for puts, the risk of investment. So I'm actually going to just kick this slide to next week as the first slide of, not next week, of Thursday's presentation. Let's give ourselves a few minutes of Q&A. I know that we're at time. Suck it to me. What option question do you have? I hope that you're starting to just kind of, some of the terms that you hear around options are starting to make a little more sense. It'll definitely make sense when we build a trade and we get into the foundation. So hopefully, if nothing else, it's whetting your appetite for the options foundations course. And if your question is about something other than options, please still ask it. All right. Well, out of curiosity, before we go, are you an options trader? I'm going to do a quick informal survey. Are you an options trader now? And you could just say now. Are you wanting to be an options trader in the future? Say future, or have no interest? Say never. Now, future, never. Give me some indications. Okay. I've got a now, future. Okay. All right. Very nice. Oh, got some coming in the Q&A. I have a Schwab account. They'll let you do it. Oh, beautiful. Love it. Whoever said that, the Q&A came in anonymous. And you're in now, but that's the Schwab account. If they let you try it, hopefully they're going to let you download the Thinkorswim, and on the Thinkorswim you could use the paper platform. It's amazing. I mean, it is absolutely amazing. So anything that you watch me do in the trading in the rooms, I'm doing on Thinkorswim. The charts, the looking at an option chain. If we look at analytical, like option theoreticals, all of that. Oh, and I didn't adjust my slide. Up next on Thursday is Intro to Options Part 2. Intro to Options Part 2. Next week, we're only going to meet on Tuesday because of the Thanksgiving holiday. On Tuesday, we're going to do post-trade assessments. That will be a good one where you can kind of learn a process for breaking down a trade after the fact, analyzing what you did, giving yourself an assessment, trying to walk away with patterns of behavior that you see that can be addressed and fixed. So Intro to Options Thursday. We've got a few futures, a few nows. I love it. More options on Thursday. Thank you, everybody. We'll talk tomorrow morning. We'll see. Do we get another opening round of positive futures and a little bit more follow through? I wouldn't be surprised to see more follow through. Definitely looking to see how much this bullish move can carry. Have a wonderful rest of your night. Thanks for hanging out. And as always, happy trading.